Hi, this is Matthew Cratter from Trader University, and today I want to talk about how not to invest for the 2020s. If you're interested in learning investment strategies, trading techniques that actually work, or just want to see what I'm investing in or trading at the moment, be sure to hit that subscribe button. So the theme of this piece is really going to be generals fighting the last war. Not only are generals guilty of this, but money managers and retail investors are as well. And I hope to demonstrate this by just looking at stocks over the last few decades, looking what the big winners were from each decade, and then looking at how people were positioned going into the decade. So we'll start with, we're just going to do this for every 10 years leading up to 2020. We'll start with 1980. And the real standout here is 1980. These are the 10 largest companies, publicly traded companies by their market cap. The real standout here is obviously what I've highlighted in red. These are all oil and gas companies. And this is really the U.S. economy in particular back in 1980 was much more commodity based. The energy companies, in particular the oil companies, were a huge percentage of the S&P 500. And the thought was that we're entering an era of peak oil. There had been a lot of inflation in the 1970s, obviously. And so the thought was you've got to invest in just the U.S. Everywhere else is too dangerous because inflation was really wreaking havoc much more in developing countries. So you want to invest in the U.S. and you want to invest in big oil companies. That's the main sort of theme at the beginning of 1980. We can see here that we also had IBM, which was really the only big tech company for many, many years. Big mainframe computers before they moved into PCs. But the real significance of 1980 and the great irony here was 1980 was when IBM signed their deal with Microsoft to provide the operating system for their soon-to-come-out personal computers. And IBM did well for a while, but this was ultimately the death knell for IBM as a technology leader. It was never really the same after it ceded so much. This is probably the worst business deal in history, giving so much power to a small startup called Microsoft. Something else that happened in the 80s, AT&T was broken up into what are called the baby bills, the regional telecommunication companies. So that was also something significant. We can see at the bottom we have General Electric here, Eastman Kodak, two big winners from the Nifty 50s, from the big popular stocks in the 1970s. We all obviously know what happened to Eastman Kodak. It did perform well for a while. But the main theme here in 1980 is you want to be long oil and you want to be long U.S. stocks. Now, what happens over the next 10 years? What stocks actually really do really well? All the red companies here are Japanese companies. The 1980s was the era of Japan. And there was a lot of concerns, actually, especially by the end of the 1980s, that the Japanese were buying up all the California real estate, that they were just going to take over the world. Obviously, a remarkable recovery after World War II, and they really came into their peak of power by 1990. So you can see here some Japanese conglomerates, industrial companies, Toyota, obviously, and then some banks. And so the thought in 1990 was you want to be long Japan because it's taking over the world. U.S. is much less important. And this is quite ironic, especially given that this was the Netscape IPO was just a few years away and the whole tech revolution, which was really centered in California. We can see on this list we still have ExxonMobil, but all the other oil majors had dropped off the list. Now, what also happened in 1990? There's a great irony here in that the stock market peaked in really at the end of 89. Here's a chart of the Nikkei 225, the main index for Japanese stocks. And Japanese stocks have never recovered from this. There's been tremendous deflation in Japan ever since this. Japan is sort of has these various demographic issues. A lot of deflation. They're the first country to really print money and buy their own bonds. The national bond market was essentially nationalized by their central bank, the BOJ, buying all of their bonds. And in many ways, Japan is sort of a precursor to what may be happening in the U.S. right now. But you can see here that Japanese stocks have gone nowhere since that peak. In fact, they were still hitting new all-time lows 20 years later, and they've recovered a bit since, but still not the place to be. So this is another case of generals fighting the last battle. And so if you were overweight Japan, if you were overweight, especially Japanese banks, real estate companies, you just got really wiped out for the next decade and really the next few decades. So those are the biggest market cap winners at the beginning of 1990. Now let's fast forward to 2000. So if you were following this, you would have been positioned, you would have been heavily overweight Japan, and you would not have had a good decade, because the real winners in the 1990s, as we know, were really up to the peak of the tech bubble in March of 2000, were the really big tech companies, in particular Cisco, Microsoft are the two that really make this list. General Electric became a very faddish blue chip stock, and we can look at where it was in 2000. That might be interesting to do, since that's a stock that's caused a lot of people a lot of pain over the last decade. But it basically, you can see that it basically peaked with the Nasdaq and other tech stocks, even though it was really more of a finance company at this point. Completely mismanaged, accounting fraud, etc. But this was the big winner as of 2000, and you can see that if you bought it in 1990, you had a really, really good run. I remember everyone talking about this was the one must-own stock, and really obviously underperformed since then. So we had the tech stocks. There are a couple that aren't listed here that also got very big, like Oracle, Sun Microsystems, Yahoo, which was shortly to be displaced by Google. But the real winners of the 1990s leading up to 2000, the oil companies continued to do well. ExxonMobil, Exxon merged with Mobil at some point in I believe the late 90s. Royal Dutch Shell, which is obviously in Europe. And then Pfizer did really well, trading all these stocks trading at very, very high PEs by the end of 2000. And it really meant that they would underperform. Even Microsoft massively underperformed for the coming decade. Walmart continued to do well. They were still growing at a fairly fast clip in 2000. And Citigroup still had its good days ahead of it with the housing bubble that was about to inflate. But companies like Vodafone, Cisco have never really been the same since 2000. So if you were a portfolio manager or a general who was fighting the last war in 2000, you would have been overweight what were back then called TMT companies, technology, media, telecoms. You would have been overweight these companies and their suppliers like Cisco. You would have been overweight the U.S., underweight emerging markets. And of course, what happens in the coming decade? The Nasdaq tech bubble pops, and you have sort of a lost decade for American stocks. You have the housing crisis and the great financial crisis of 2007 and 2009. And when we reemerge on the other side of that, after this huge run-up in housing stocks and U.S. banks, which were over-leveraged, ended up blowing up with the whole mortgage crisis, as you know about if you've seen or read the Big Short. What does the world look like 10 years later? If you had been overweight the U.S. and overweight tech in 2000, you would have done very, very badly, because the real winners were commodity stocks. A lot of these commodity stocks being driven by the money printing, the quantitative easing that started in late 2008, early 2009. But the real winners, as of the snapshot in 2010, by market cap, you can see the red companies in red: ExxonMobil, PetroChina, Petrobras, Royal Dutch Shell. We're seeing how Royal Dutch Shell and ExxonMobil still continued to be at the top of the list, like they were in previous decades. But commodity stocks doing really well, in particular oil and gas stocks, oil majors, and also the mining stocks, BHP, Billiton, which is now just called BHP. They mine coal, copper, iron ore. They also do some petroleum work as well. They had done really well. Obviously, Apple is sort of its own story. It had invented I guess it was right at the beginning of the iPhone here. I think the iPhone came out in 2007 or 2008. And so Apple was really ramping up for the 2010s. Obviously Microsoft as well, after sort of a lost decade, still one of the largest market cap stocks. But if you, in Nestle food and drink company, right here at the bottom, sort of a safe hedge, consumer staple during the great financial crisis, etc., and paid a good dividend back then, so people liked it. But in 2010, if you were a general fighting the last war, if you were a hedge fund manager, I remember this, there was a lot of talk, you got to be, the concerns about peak oil were back, and the concerns about China taking over the world as well. So you needed to be long Chinese banks to the extent that you could, ICBC, Industrial and Commercial Bank of China, China Construction Bank. The Chinese did a huge stimulus package in 2008, 2009, and really flooded the markets with liquidity along with the Fed, and they began building sort of their notorious, a lot of cool construction projects, but also big empty cities. And so going into the 2000s, if you were overweight oil stocks, worried about peak oil, and China taking over the world, this was the exact wrong way to be positioned. If you're long Apple and Microsoft, you did well, but mining stocks, petroleum stocks, got completely crushed. And as we know, I guess in 2010, we'd say people were more overweight overseas stocks, non-US stocks, because of the bursting housing bubble and the almost collapse of the US financial system. People were long, like to talk about emerging market stocks, like to talk about commodity stocks. And so instead, what happens in the 2010s? The US massively outperforms everyone else. And tech stocks, which is the real reason the US performed in terms of stock market cap, tech stocks really take over the world, and the really big ones being centered in the US and to a lesser extent China as well. If we look at how emerging markets performed in the 2010s, if we look at, I believe it's EEM, this is the emerging markets ETF, we can see that it really had a lost decade as well. Whereas the S&P 500 was just from 2010 to the outbreak of the coronavirus, the S&P 500 was the place to be, along with the QQQs, because of the FAANG stocks, because of the big tech stocks. And so people who were positioned thinking that China was going to do really well and that oil stocks were going to do really well, they really had their dreams crushed, especially the first quarter of 2020, as well as 2018, 2019, ExxonMobil selling off really hard, along with declining oil prices. So people were massively long China, massively long commodity stocks. Instead, you should have been massively long the US and massively long tech stocks. So where are we now, beginning of 2020? Obviously, the FAANG stocks and other tech stocks have taken over the world. The top three of these, Microsoft, Apple, Amazon, all have trillion-dollar market caps. Alphabet, Google is close. We have the two Chinese internet stocks, Alibaba, e-commerce, and then Tencent, obviously kind of a big tech conglomerate, as well as Facebook. And so the last decade has really been the outperformance of big tech. And the thesis is the U.S. is the place to be, and these are monopoly tech giants that are going to be taking over the world. Berkshire Hathaway is still hanging in there, even though Buffett has really underperformed the S&P for the last 20 years. Still a very big, diversified company. With Buffett being 89 or 90, it's probably not the best place to be, not the most exciting place to be, especially given its size. And a lot of what we've seen over this presentation is the sort of the law of large numbers, where if your company is already very, very big, it becomes much more difficult to grow it, and you begin to become almost as big as the markets that you inhabit. And the two that really stand out for me going forward, especially, would be Alphabet, Google, and Facebook, which are basically advertising companies. In a few years, they will have completely saturated the advertising markets, and to that extent, that should really slow down their growth, because they once they take market share from all the traditional advertisers, their growth rates will really be limited by the growth of the U.S. economy and the growth of advertising in general. And maybe they coexist as a duopoly structure. Maybe Facebook gets taken down for some of its bad behavior. But those would be two examples of what seem to me to be mature markets. Obviously, there's some optionality with a company like Alphabet, Google, with their self-driving cars and their quantum computers and all the weird stuff they're working on. You could have an outsized winner emerge from that, though there is some debate about how healthy the innovation culture is at Google. They seem to be, a lot of the executives over the last few years seem to be much more focused on sexually harassing their employees than actually developing new things. So what can we say going forward? Going forward, coming into 2020, the market generals were saying you want to be long the U.S. and you want to be long FAANG stocks, you want to be long tech stocks. Now this may turn out to be okay, but based on our previous decades, it's not the best bet to make. These companies are already quite large. A company like Amazon can still move the dial by maybe moving into healthcare, moving into payments. But a lot of these markets, a lot of these companies, Apple included, have really saturated their markets, and they really need big new opportunities to move the dial of their revenue growth and their earnings growth. At the same time, they're facing sort of political headwinds. People are waking up to how these companies stifle innovation and play patent games and buy up their competitors and shut them down or roll them in. And so there are increasing cries to break up Amazon on both sides of the aisle, break up Facebook because of its bad privacy practices. And so there are these antitrust headwinds, as well as just the law of large numbers, where it's unclear how big these can grow. Visa is still there. Johnson & Johnson is still there. Johnson & Johnson may have a COVID vaccine. I don't know. But not the most too exciting companies. Visa does have the network effects. But as we move into the 2020s, it's unclear whether they can really keep their lead or keep their pseudo monopoly. So what this suggests is that maybe for the 2020s, being long the U.S. and being long U.S. tech stocks is not the best place to be. I would say the other real fad that has really took hold in the 2020s was stock market indexing. It really came into its own. The idea that you're just supposed to cost average into the S&P 500 or another big index. I did a whole video on this, which I'll link below, and the problems with it. Right now, the big tech stocks are something like 20% of the S&P 500. So you have this weird dynamic where the S&P 500 is becoming less and less diverse over time. You're buying a market cap weighted index. It's highly weighted toward these big tech companies. And as a result, it could go down a lot, could underperform for some of the reasons we've talked about. I've shared this, so I'll link to this video about the problems with indexing. Even Jack Bogle, who invented the first index fund, has said that there's a problem with this, especially as index funds and shadow indexers become a larger percentage of the stock market and active investors are pushed out. You get a very strange situation where no one is really doing the fundamental analysis or the price discovery that you really need to value companies. Lynn Alden had a great chart here, which I referred to in a previous video, basically showing how over the last 5 years in particular, the blue line here is the NASDAQ 100, the QQQs, how really all the performance has come from the big tech companies, as we said. And if you start looking at equal weighted versions of the S&P 500, you begin to get flat to negative numbers. Emerging markets, EEM, really underperformed everything. So this suggests that from a contrarian point of view, at least, you probably want to be overweight emerging market stocks over US stocks. You want to be overweight small cap and mid cap stocks. And unless, of course, you believe that the monopoly privileges of companies like Apple and Amazon and Google and Facebook will continue. A lot really depends on who's elected in the U.S. in the November 2020 elections. But there will be pressure definitely to break these up. So what do I like for the 2020s? I would say that because of all the central bank money printing that's been going on and the devaluation of the dollar that's going to have to take place for the U.S. to emerge from all of its federal debt and corporate debt, etc., I really like fixed supply or scarce assets that function as a store of value and do really well in money printing environment. So I really like gold. I like the gold miners, the gold royalty companies. My favorite is Bitcoin. I think Bitcoin really comes into its own in this decade and becomes much more mainstream. You can check out my Bitcoin videos, which I'll link to below. I think Bitcoin really will be the outperforming asset of the 2020s. And if it is, this would be an exception because it was the outperforming asset of the 2010s as well. Other trends I see for the 2020s, really driven by COVID as well, would be a renewed interest in biotech companies, vaccine companies, companies that are studying aging, longevity, curing chronic diseases like metabolic syndrome, diabetes, etc., or otherwise just working on increasing lifespan. I think that as a population gets older and richer, the one thing they're really willing to spend unlimited money on is buying themselves more time, taking drugs or therapies or treatments that will extend life. So biotech's very exciting, as well as VR, virtual reality. And Facebook, obviously, with their purchase of Oculus Rift, is on top of this. We'll see whether they can do anything with it. But virtual reality, as everyone's moved on to Zoom and online platforms during the shutdown, people are discovering that in many ways the virtual world is as interesting or more interesting than the real world. And we've had a lot of online concerts, online sports, etc. So biotech, I would say biotech, Bitcoin, gold, and VR would be really interesting ways to be positioned for the 2020s, and as ways of not being a general or money manager, fighting the last war. I think we're going to see a sideways market going forward, where the S&P doesn't really hit new highs for a number of years. And if so, you're going to want to focus much more on trading strategies, bear market trading strategies, and sort of shorter term strategies, as well as crypto. So if this interests you, check out my courses. If you enjoy the way I teach, you can check these out. You can go to the link in the description notes below, click on any of these, and it'll give you the curriculum. I especially like swing trading with options, and then the flagship course, Learn to Trade Stocks Like a Pro. If you're interested in learning options from a really beginning level to really advanced level, you can check out Learn to Trade Options Like a Pro, as well as my futures trading course. If these interest you, after you take a look at them and check out the curriculum, you can just click Get It Now right here, which will take you to the checkout page. And I want to give you a special coupon because we're in a recession. So if you scroll down here where it says have a coupon code and you type in YT, as in YouTube, 99, you click Update, that'll take $26 off the price. So instead of being $125 for 30 days access, it'll just be $99. And you can cancel at any time. There's no long-term contracts or anything like that. So you can watch all 13 courses, cancel before the 30 days is up, and you won't be charged again. I'm constantly adding new courses and new lectures, and as a subscriber, if there's something you'd like to see added, you can let me know, and I'll make a course just for you and share it with everyone. I'm trying to make this really the best trading and investing resource, along with my YouTube channel and my Amazon books, the best source for all these things for new traders and advanced traders as well on the internet. So check those out. Hit that subscribe and like button if you found this video helpful, and let me know your questions and comments in the comment section below. Hope you're all staying well, and I'll see you in the next video.